In 1968, one of the most successful hedge fund managers in America was running money for some of the wealthiest families on Wall Street. His name was not important then. It is not important now. What is important is what he was and what he represented. He was brilliant, genuinely, measurably, undeniably brilliant. He had graduated at the top of his class from one of the finest business schools in the country. He tracked every market, every trend, every signal. He worked 18 hours a day, 7 days a week, with the kind of focused intensity that most people can only sustain for a few months before breaking. He was, by every visible measure, doing everything right. People talked about him. Investors wanted to be in his fund. His returns were extraordinary. His confidence was total. He believed with the complete, unshakable certainty of someone who had never been seriously wrong, that he understood what he was doing. By 1970, he had lost almost everything. Not because the market crashed, not because of bad luck or bad timing or any of the external forces that investors typically blame when things fall apart. He lost almost everything because the urgency, the constant, relentless, grinding need to be right, to be ahead, to be winning every single day, had compounded into a series of decisions that destroyed in months what had taken years to build. The positions got too large because the confidence demanded it. The time horizons got too short because the urgency demanded it. The diversification disappeared because concentrating felt smarter. And when the market moved against him, as the market always, eventually moves against everyone, there was no margin of safety. No protection, no room to be wrong. Warren Buffett watched this happen from Omaha. He read about it. He heard about it from mutual acquaintances. And he felt something that surprised him. He did not feel superior. He did not feel vindicated. He did not feel relieved that it had not happened to him. He felt recognition because he recognized the man in that story. He recognized the urgency, the certainty, the need to see the number move every day. The inability to sit still while compounding did its quiet, invisible work. He recognized himself, the version of himself he had been, the version he had just barely stopped being in time. And this recognition, this uncomfortable, honest, private acknowledgement that he had been running the same race toward the same cliff, is the real beginning of the Warren Buffett story. Not the investments, not the returns, not the billions. To understand what changed, you first have to understand what Buffett was like before the change. Because the image most people carry of him, the serene, unhurried figure in Omaha, reading annual reports while the world rushes past, when making one significant move every few years, seemingly impervious to the emotional volatility that destroys most investors, is not the man he started as. The young Warren Buffett was driven in a way that made people around him uncomfortable. He kept a running tally of his net worth in his head at almost all times. He would calculate at various points during any given day exactly how much money he had accumulated and exactly how far he was from the number he had decided he needed to reach. He was obsessive about the count, restless about the pace. The money was never enough, and not enough never felt good. He is described in various reflections over the years, a version of himself in his early 20s who was so focused on the accumulation of capital that it distorted his relationships, his judgment, and his decision-making in ways he did not fully recognize while it was happening. He was good at investing, already extraordinarily good, already running circles around investors twice his age, but the wanting was making him worse than he could have been. The urgency was compressing his time horizon. The need to see the number grow was pushing him toward decisions that produced results in the short term at the cost of what the long term could have become. He was trying to get rich, and trying to get rich, as he would eventually come to understand with a clarity that changed everything, is almost perfectly designed to prevent you from becoming wealthy. The distinction Buffett draws between getting rich and becoming wealthy is not a semantic game. It is one of the most important financial ideas he has ever expressed, and it is almost entirely absent from conventional financial education. Getting rich is a goal with a number attached to it, a destination, an endpoint, a finish line that keeps moving. When you are trying to get rich, every financial decision is evaluated against a single question. Does this move me closer to the number, and how fast? This orientation produces a specific and recognizable set of behaviors. Short time horizons because the number must move now. Inflated risk tolerance, driven not by genuine analysis, but by impatience. A tendency to chase what is working right now rather than what will work over time. An inability to sit still and let compounding do what compounding does, because sitting still feels indistinguishable from falling behind. Think of someone you know, perhaps yourself, who checks their investment portfolio every morning before breakfast, who moves money toward whatever performed best last quarter, who has a different strategy every 6 months because the previous one did not produce visible results fast enough, who feels the market's daily movement as a personal verdict on their financial intelligence. That person is trying to get rich. And every behavior that defines their approach, the checking, the chasing, the pivoting, the anxiety, is working against the very outcome they are trying to produce. Becoming wealthy is something entirely different. It is not a destination. It is a direction. It is the natural result of a set of behaviors sustained over a long enough period of time. Behaviors that individually and in the short term look almost nothing like the pursuit of wealth. Reading, thinking, waiting, owning, holding, saying no to almost everything. The person trying to get rich is running towards something. The person becoming wealthy is building something. And the difference between running and building, in what they feel like, in what they require psychologically, in what they produce across decades, is the entire distance between financial anxiety and financial freedom. Buffett spent his early years running. He was very good at it. He was producing returns that most investors would have considered extraordinary. And he could see with increasing clarity that it was not going to be enough. The shift did not happen all at once. It was not a single conversation or a single loss or a single moment of revelation. It was a slow accumulation of evidence, of observed failures and quiet reckonings that the way he was approaching money was producing a version of himself he did not want to become. Part of it came from Benjamin Graham. Graham had shaped Buffett's entire analytical framework, had taught him how to read a balance sheet and identify value and think about risk. But what Buffett noticed, watching Graham operate over years, was something that had nothing to do with technique. Graham was not particularly interested in accumulating wealth. He was interested in the intellectual problem, in the puzzle of valuing businesses, in the rigor of the analysis, in the craft of identifying what something was actually worth versus what the market was currently paying for it. The money was almost incidental, a scorecard for a game he genuinely loved playing. And this lack of urgency, this genuine indifference to the pace of accumulation, did not make Graham a worse investor. It made him a better one. Without the emotional pressure of needing the outcome by a specific date, Graham could evaluate opportunities more clearly, hold positions more patiently, and resist the reflexive reactions that urgency reliably produces. The detachment was not a weakness. It was a structural advantage that compounded quietly across every decision he made. Part of it came from Charlie Munger, who entered Buffett's life in the late 1950s and spent the next several decades dismantling the parts of Buffett's thinking that were not working. Munger's philosophy was built on inversion, on asking not what you should do but what you should avoid, not what produces success but what reliably produces failure. And when Munger applied this lens to the pursuit of wealth, what he found was consistent and damning. Urgency, impatience, and the desperate need to see the number grow were among the most reliable predictors of poor financial outcomes he had ever observed. Munger told Buffett, in various forms over many years, that the goal was not to get rich. The goal was to avoid being poor, to eliminate the mistakes that destroyed wealth, and to let everything else take care of itself. This sounds passive. It is actually the most demanding financial discipline imaginable, because it requires sustained resistance to the most powerful emotional forces in investing. And part of it came simply from time, from watching what happened to the people who were urgently, visibly, desperately trying to get rich. Some of them made spectacular gains. Almost all of them eventually gave those gains back, and often more. The market rewarded patience with a consistency it never extended to urgency. The evidence accumulated. The lesson became impossible to ignore. Buffett stopped running. He started building, and the $100 billion that followed was not the result of what he started doing. It was the result of what he stopped. What does building look like in practice? What does a financial life oriented around becoming wealthy rather than getting rich actually produce on an ordinary Tuesday afternoon? For Buffett, it produced a calendar that looked, to most outside observers, profoundly and almost insultingly unproductive. Large blocks of time with nothing scheduled. Long periods where no decisions were being made, no transactions were being executed, no visible progress was occurring. A morning spent reading a single annual report. An afternoon spent thinking about one question. An evening spent doing nothing at all. It produced an investment approach that can be described, without exaggeration, as doing almost nothing almost all of the time. Finding a small number of genuinely exceptional businesses, buying them at fair prices, holding them for years, sometimes decades without touching them, watching them compound, not reacting to quarterly earnings reports, not adjusting for market conditions, not taking profits because the price had moved favorably, not diversifying into the next interesting opportunity because diversification felt responsible. It produced a relationship with money that most people would find psychologically impossible to sustain across even a few months, let alone decades. When the market crashed, and it crashed multiple times, dramatically, Buffett did not experience it as a threat. He experienced it as a sale. Prices on businesses he wanted to own were lower than they had been. That was good news, not bad. When the market soared, he did not feel validated. He felt more careful. The environment was less favorable for building. Discipline was more important, not less. This is not how most people experience market volatility. Most people feel the crash as a personal loss, a verdict on their judgment, an emergency requiring action. Most people feel the rally as a reward, a confirmation that they were right, an invitation to take more risk. Both of these emotional responses, Buffett understood, were the fingerprints of someone still running, someone who had not yet made the shift. Someone whose financial outcomes were being determined not by the quality of their businesses but by the quality of their emotional regulation on difficult days. The building approach removes this problem by removing the emotional stakes. If you own great businesses at fair prices and your intention is to hold them for a decade regardless of what the market does, the market's daily verdict becomes irrelevant. Not philosophically irrelevant, actually irrelevant. It genuinely does not matter. And when it genuinely does not matter, you stop experiencing it as a threat. You stop running from the volatility and toward the next safe thing. You stop, and the compounding continues. There is a test Buffett applies to every investment decision he has ever made. A test so simple that sophisticated investors frequently dismiss it as hopelessly naive, and so powerful that it has guided one of the most extraordinary wealth-building careers in human history. Would I be comfortable owning this business if the market closed tomorrow and I could not sell it for 10 years? Notice what this question does not ask. It does not ask whether the price will go up. It does not ask whether the timing is right. It does not ask whether something else might produce better returns in the near term. It asks only whether the business itself, its economics, its competitive position, its management, its trajectory, is something worth owning for a decade regardless of what the market does in the interim. Most of the investments that the urgently trying to get rich investor makes do not survive this question. They are not businesses worth owning for 10 years. They are positions taken because the price has been moving, or because other people are excited about them, or because the short-term thesis looks compelling. They are running decisions dressed in the language of investing. The businesses Buffett owns survived the question easily. He would be entirely comfortable owning Coca-Cola, American Express, and the rest of Berkshire's portfolio if the market closed tomorrow. That comfort is not emotional. It is analytical. It reflects a genuine understanding of what these businesses are worth, how they generate value, and why that value will persist across time, regardless of what the market's mood happens to be on any given Tuesday. The question is a filter. And what it filters out is almost exactly the set of behaviors that distinguish running from building. It removes urgency. It removes social proof. It removes the reflexive reaction to price movements. It leaves behind only what a genuine long-term owner, someone who has stopped trying to get rich and started becoming wealthy, would actually do. Here is what this means for you. Not in theory, in the decisions you are about to make this week. The first is to ask yourself, with complete honesty, whether you are currently running or building. This is not a comfortable question because running feels like ambition, and ambition is supposed to be good. Running feels like effort, and effort is supposed to produce results. Running feels like doing something, and doing something is supposed to be better than doing nothing. But running, sustained across years and decades, almost never produces wealth. It produces transactions. It produces activity. It produces sometimes spectacular short-term gains that evaporate before they compound into anything lasting. The hedge fund manager from 1968 was running. He was running brilliantly. He ran himself off a cliff. Building produces wealth. Slowly, quietly, in a way that looks from the outside almost identical to doing nothing, and is from the inside the most demanding financial discipline most people will ever attempt. The second is to apply the 10-year question to every financial decision you are currently considering. Every single one, not as a rhetorical exercise, but as an actual filter. Would you be comfortable owning this for 10 years if you could not sell? If the answer is no, the decision is probably running, not building. Set it aside. Wait for something that passes the test. Most people, when they apply this test honestly for the first time, discover that the vast majority of moves they were about to make do not survive it. This is not a sign of bad judgment. It is a sign of the test working correctly. It is showing you the difference between decisions made from genuine understanding and decisions made from urgency. The third is to stop measuring your financial progress by price. Start measuring it by quality. The quality of the businesses you own, the durability of their competitive advantages, the integrity of their management teams, the reliability of their earnings across different economic conditions. These qualities change slowly. They do not fluctuate daily. They are not exciting. They are not the stuff of cocktail party conversation, but they are the actual determinants of long-term financial outcomes. And the investor who learns to measure them rather than the daily price of their holdings has made one of the most valuable mental shifts available in personal finance. The fourth is to widen the gap between what you earn and what your lifestyle costs, and to treat that gap as the engine of everything. Buffett has lived in the same modest house in Omaha since 1958, not because he cannot afford a different one, because he understood, early and permanently, that upgrading the lifestyle is running. Every upgrade raises the baseline. Every raised baseline increases the financial pressure. Every increased financial pressure shortens the time horizon. And shortened time horizons produce exactly the urgency that destroys building. His specific instruction to young people: every time your income increases, deploy the difference rather than spending it. The gap between earnings and lifestyle is the raw material of compounding. Protect it, widen it whenever possible. Never narrow it for anything that does not genuinely matter to you. The fifth is to build what Buffett calls the inner scorecard, not the outer one, not the portfolio value, not the lifestyle visible to others, not the story you can tell at dinner. The inner scorecard is a private, honest accounting of whether your decisions are grounded in genuine understanding or in the need to feel like you are moving. Before any financial decision, ask, am I doing this because I understand it and believe in it for a decade or more? Or am I doing this because I am anxious, or because someone else is doing it, or because doing something feels better than doing nothing? The honest answer for most people most of the time is the second one, and that honesty, uncomfortable and inconvenient, and occasionally humbling, is the beginning of building. Not because it tells you what to do, because it tells you what not to do, and not doing the wrong thing, compounded across decades, is most of what building actually requires. The sixth is to invest in your own knowledge before you invest in anything else. Read not financial news, not market commentary, but the actual substance of how businesses create and destroy value, how competitive advantages are built and eroded, how capital moves through economies over long periods of time. Buffett reads 500 pages a day, 1 hour a day for you, every day, for 10 years. The knowledge compounds the same way money does, and it produces the same exponential results. Without it, the urgency always returns. With it, the building becomes almost natural, because you understand what you own well enough that the daily noise of the market genuinely stops mattering. The seventh, and this is the one that ties all the others together, is to redefine what success looks like in your financial life. Success is not the number. The number is a byproduct. Success is the quality of the decisions, the patience sustained, the urgency resisted, the businesses understood and owned and held across the years when everyone around you is running and you are standing still, building something they cannot see yet. The hedge fund manager from 1968 had a big number. He ran very hard toward it. He ran himself off the edge. Buffett stopped running. The number followed him. Not because he chased it, because he stopped chasing it and did the only thing that actually produces it. Warren Buffett stopped trying to get rich somewhere in his late 20s. He is now in his 90s. The 6 decades between produced one of the most extraordinary accumulations of wealth in human history, not by running faster than everyone else, but by stopping when everyone else was sprinting and building something they could not see. The stopping is the hardest part. It requires resisting every instinct, every cultural pressure, every anxiety about falling behind. It requires being willing to feel, for months and sometimes years, like nothing is happening, while something extraordinary is quietly accumulating beneath the surface. Buffett stopped trying to get rich on a day that nobody remembered. Nobody was watching. There was no announcement. There was just a man in Omaha who recognized himself in someone else's failure, put down the urgency, picked up a book, and started building. The wealth was never the goal. It was always just the result. And it is still available to anyone willing to stop running long enough to start building. The question is not whether you are capable of making the shift. You are. The question is whether you are willing to feel like you are doing nothing, while the most important financial work of your life quietly gets done.